Hello, everyone, and welcome to the Currency Exchange, a NatWest Markets podcast all about foreign exchange markets. I'll be your host today, Brian Daingerfield, and I'm the co-head of G10 FX Strategy here at NatWest Markets. Next week, we're all looking forward to the Fed decision and a couple of surprise interest rate hikes by the Fed's G10 colleagues in the past week has really raised some intrigue about whether the Fed could follow suit with a surprise of their own. Specifically, we're talking about the Bank of Canada and the Reserve Bank of Australia, which each hiked their policy rate by 25 basis points at their early June meetings. So to discuss the Fed, the outlook for the Fed, what we think about next week and beyond in the U.S. economy, I'm very happy to be joined by our chief U.S. economist, Kevin Cummins. Kevin, thanks for joining.
Thanks for having me.
So Kev, I just want to start off with an easy one. Do you think the Fed hikes at the June meeting, or do you think they skip this one?
Yeah, I think the Fed skips this one. I think the leadership of the Federal Reserve wants to kind of catch its breath and see how the earlier 500 basis points in tightening over the past 10 FOMC meetings starts to impact the economy. And so I think this is kind of a good stopping point for the time being for them to, pause at this meeting.
So it certainly feels like there's some interest among Fed leadership, especially, to maybe take a step back here and take out a little bit of insurance at this stage. I do want to ask you about some of the other details of the Fed's decision, because it's not just going to be about the specifics of hike or skip. There's also the summary of economic projections, there's the dot plot, and then, of course, there's any guidance that the Fed might give in the statement. How are you thinking specifically about the dot plot? Do you think the dot plot's going to evolve to show that Fed members are still thinking about additional interest rate hikes?
I do. I think this is one of the meetings. The Fed historically has kind of used the dot plot when it's convenient, and I think it's a convenient time right now. Given the backdrop of inflation is probably a little bit more sticky than they were hoping by this point in time, given the speed and the magnitude of earlier rate hikes. So I think, as I had said, with a pause here next week, I think it's convenient for them to kind of lean on the dot plot, probably a little more than some other ones. I mean, there's a variety of views from the most hawkish members like Bullard to probably the most dovish members like Goolsbee, who, have a say at the meeting. And I think that they want to retain as much optionality going forward, that they can hike or they can go on an extended pause, or eventually they'll start to probably cut rates. So, I think they can use the dot plot this time around to show that they haven't lost their vigilance on inflation, and that if it does remain stickier than they perceive, in the next couple of reports, they can resume tightening, and they have that flexibility to get it going again and move rates higher.
I think it's right and really important that you highlight flexibility and optionality for the Fed coming out of this meeting. I feel like if you were to try and categorize this meeting in just a few short words, it would be the Fed wants to execute a rate pause without convincing the market that this is the rate pause, where the rate is simply not going to move from here. A lot of the Fed guidance earlier in the tightening cycle was, let's get the policy rate up to a sufficiently restrictive level as quickly as possible, and then leave it there for a sustained period of time. But it certainly feels like now that conversation is shifting a little bit, where there is some tolerance for maybe we can skip a meeting, maybe we can slow the pace a little bit further of getting the policy rates at that level. So I think it's super important, like you said, Kevin, that the Fed tries to pair a skip at this meeting with evolution of language to try and suggest that, hey, this is not necessarily the end of the tightening cycle. I think the hawkishness is going to be, up and down the press conference. I think they're going to try and really reinforce that optionality. So I do want to ask you about your expectations for the economy and for the Fed. The Fed is, I think, going to probably try and talk a big game about the possibility of hiking again. Do you think that's the most likely outcome? And how are you feeling about both the Fed cycle and the evolution of the economy from here?
Yeah, and to hit on the first one, I do think that the Fed wants to use the dot plot to signal that they have the option of going again. So I think the median dot for 2023 is likely to be nudged up from where it was in March. March showed the terminal rate at 5.25%. And I think we're likely to see that nudged up by another 25 basis points to 5.5. But that optionality that we were discussing, I think they're going to show a pretty wide divided committee, allowing for that sort of best options going forward. So we may see, and I think the headlines will say, that the committee is really divided in their approach for the remainder of this year and the rate hike cycle, that we're likely to see a pretty even dispersion amongst officials of either no hikes, one hike, or two hikes. So I think, you're going to get a lot of flexibility from the Fed and what's the best course of action. And I think at this point in time, as you mentioned, they're trying to decide whether or not they are currently at a sufficiently restrictive level. So, they're probably would err on the side of going sooner rather than later and skipping several meetings. But I think, they're going to want to be more data dependent now, and they'll want to, go meeting to meeting or kind of report to report to see how things are currently evolving in the economy. And I think, to touch on your second point, I think the inflation backdrop hasn't really shown all that much of an improvement. We've seen some improvement since the middle of last year, if you're looking at year-on-year changes, but the more recent incremental month-to-month changes, for example, within the CPI, we've had a pretty strong string of 0.4s for the most part over the past several months. I think there was a 0.5 that stuck in there as well. And next week on day one of the FOMC meeting, we're likely to get what's going to be another difficult report, we think. In the core, we have it rounding barely up to 0.5, but that wouldn't show all that much progress that the Fed wants to see. So I think the current odds that the Fed hikes in June are about 30%. I think the Fed has kind of given, starting with the Fed chair back on May 19th, pretty good guidance that he wants to kind of see how things evolve, and the tightening in credit conditions probably does some of the job of rate hikes. So, I think that they're likely to kind of catch their breath, see how things evolve, and then potentially resume rate hikes in July or maybe even September if necessary. But I think they want to show in that dot plot a variety of options that they can follow here. Our own view is that the economy is going to tip into a recession later this year. So with regard to, inflation, we probably are in the worst of it has already passed. And I think in the back half of the year, you're likely to see some modest deceleration in inflation. Those year-on-year numbers will come down. Presumably that, if rents continue to show some signs of moderation. And if we're right, the economy tips into a recession. I think it's just a matter of time that, the inflation data start to catch up and you start to see numbers, giving the Fed more confidence that inflation is going to go back down towards their 2% target over time. So, that's our base case. And that sort of backdrop, we haven't changed our call. We still think that the next move from the Fed is going to be down rather than up. And we have, a cut by the end of the year, 50 basis points if our forecast for a recession is realized. So that's kind of where we stand right now.
Yeah, I think you hit on a number of really good points there. Thinking about the meeting coming up, really the next 7 days, it really feels like that the CPI is going to be the big data point to watch ahead of the Fed. Do you think back to what the RBA in Australia did this week and what the Bank of Canada did this week? It really felt like it was a specific event that drove those central banks to make a surprise decision. For the Bank of Canada, it was stronger than expected first quarter GDP, particularly on the consumption side, which made them think, what? From an output gap perspective, we're just not going to get there in terms of inflation. And then for the RBA, they had a surprise, larger than expected minimum wage hike that was announced in the week before their June meeting. I think it's pretty clear that that played a role as well. So I think, there's certainly differences between those two central banks and the Fed. And the Fed has clearly been gearing up in this direction in terms of a pause. But I think the market is really focused on that specific CPI. The Fed doesn't seem to have had that event risk moment where they say these data have been just way too good and we have no choice but to keep going. The CPI perhaps represents the final moment for that to happen before the June meeting. When you're thinking about CPI next week, Kevin, you mentioned that this number could be a bit disappointing for the Fed, who's looking for more progress. Are there any particular categories? And we know we should be watching services inflation. Is that still something you think is going to be what we're looking at here?
Yeah, I think, that's probably Chair Powell flagged the course or the services non-housing number in the PCE report. And, we get the CPI ahead of the PCE. So everybody kind of looks to the services components within there for some guidance on a potential action from the Fed. And, as I mentioned, our number on the core, if we're right, it's barely a 0.5, but that would be, signaling, inflation is moving in the wrong direction here. And even if our forecast is right, we're talking about like 5.5% year-on-year core inflation. So that would be, well north of their 2% target. I mean, within the details of the report, one of the bigger drivers on our core inflation number is on the good side in used car prices. Those broke to the upside last month. They were up over almost 4.5%. And we're looking for another solid gain of about 3% in May. So that would, contribute to some of the strength that we see in May relative to April. But also, rent prices, and that's such a large component. It's about 40% of the core in the CPI. So those two will be very important. We're expecting a little bit of moderation there on the primary rent to only a 0.5 after a 0.6 last month. And then the OER, which is the bigger weight within the rent component, we have that up again at a 0.5%. And then some of the other transportation related items, the airfares and lodging away from home, we're looking for pretty solid gains there too. So, I think that could be the difference. If you look at April versus this upcoming May report, you may see a little bit more firmness in some of the travel related services.
So I think the market is actually set up pretty well for this Fed meeting, with the expectation being that the Fed has, set the expectations quite firmly in the direction of they're likely to hold at this meeting, but that the guidance is going to be hawkish and that the dot plot can move up to try and make sure they continue to have that optionality. It'll be super interesting to see how the dollar responds to the CPI. And maybe the way the CPI influences the Fed's thinking is, how much credibility does the Fed have coming out of that decision? Where if the CPI comes in weaker than expected, in addition to the big jump in the initial jobless claims we saw this week and some of the weaker ISM services, maybe the market sees a little bit more comfort in fading this idea that the Fed is trying to keep that optionality open. If that CPI comes in strong, maybe the market hears that same message from the Fed in a much different light. So I believe that's all the time we have for today. Thank you very much, Kevin, for joining, and thank you everyone for listening. If you liked this podcast, please be sure to like and subscribe to our channel so you can get our latest updates when they're released. Thank you very much.